Hello and welcome back to my channel. This is Noah once again from Oasis Trading Avenue, and today we'll be talking about market structure. Okay, that being said, let's hop into the chart. Okay, so I'll take this PDF from Quantum FX Capital, and they are going to help us explain what the market structure is. I came up with this PDF. I think they were quite informative, and I would really like to share that with you. Okay, so one thing you need to understand is that the institutions have a larger equity in the market. So when they are placing trade, they tend to control the market and all. And we as retail traders, we don't really have a lot of equity in the market, so we can't trade against them. So the best thing we need to do is to trade with them. So that's where the market structure comes into place. Okay, so if you look at this PDF, they are telling us that market structure shows us as institutional traders. Okay, so if you want to become an institutional trader, we need to trade like the institution. The market structure shows us as institutional traders where the large majority of buy and sell positions are being placed in the market. Okay, so it illustrates what positions the banks are currently in, either net long or net short. Okay, and the next major trade they could be placing. The market structure is the first bricklayer of the house. Without understanding this concept, there is no foundation of your trading. So for instance, you want to be called a technical analyst in trading. Okay, you want to be called a technical trader. You see, you need to understand how the chart works. If you don't have the fundamentals or the base of market structure, or if you don't understand how market structure works, there's no way you can analyze the market. Okay, that's what this particular PDF is telling us about, which is quite true, because you need to understand how it works. It's like you don't even know, your foundation is not good, but then you want to build a story building, like the whole building will collapse in no time. Okay, so when you are able to understand structure from a macro means the higher time frames, monthly, weekly, okay, and micro, 5 minutes, 3 minutes and 1 minute time frame perspective, that will put you at the top of the 1% of the game. So the 1% of the games, or 1% in the game, it refers to the people who trade institutionally. Okay, they don't trade like a retail trader. They are not the people that get into the trade, and even though we identify the directions, our analysis and everything is good, but then we get stopped out by these institutions. Okay, yes, we are now trying to mimic how they trade and understand the footprints they leave behind, and we are going to trade that footprint. Okay, as you will understand when the banks are going to take their next impulsive move in their specific buyers. Okay. Then once you have your area of interest, we can react accordingly to the macro time frame, to the micro time frame, and get a pinpoint snapper entry and hold for long last risk to reward trades. Okay, RR means risk to reward. So this will often be used on a bigger time frames, monthly, weekly, daily, and sometimes the 4-hour. Okay, so it gives us an overview what direction price is going to trade impulsively, which we are making higher highs and higher lows on a daily time frame. We expect a new bullish trend continuation until we reach a valid area of interest or point of interest. Okay, so that being said, let us go into our chart and I will explain how the market structure looks like. So as you can see, we have the lower low, which is the LL. Okay, everything is here, so you can just have a look at everything is here, so you can just have a look at it here. Okay, so that being said, let's go into our chart. So as you can see, this is how the market structure forms. Okay, a market structure is formed when, for instance, okay, let me take where's my I don't have this. Okay, no problem. Let's discuss about an upward trend. Okay, this is an upward trend. Okay, and in an upward trend, we have series of highs and series of lows, in a sense that we have higher highs and a higher lows, a higher high and a higher low. Okay, the reason what makes a higher an upward trend valid is that if we have a new high forming, if you have a new high forming in the market, that validates our upward trend in the market. Okay, and another thing is that if our structure is being broken, okay, that's when it's termed as a continuation of a trend. Okay, so this here is called BMS. Okay, I don't know if some of you have seen me use that ever before. Okay, it's called break of market structure. Let me label it BMX. BMX. So BMX simply tells us that the structure has been broken, okay, to the direction of the market, along with the direction of the market. Okay, that's what I term as break of market structure. Some people use it as what break of structure. Okay, BOS, break of market structure, is still the same. Okay, so that being said, we now understand what happens in an upward trend. Okay, so this is how the chart moves. As you can, I told you in my last thing that market is very fractal. Okay, market is very fractal. Anything that the prices market does in 1 hour time frame, it also does the same thing in 10 minutes time frame. Okay, so this is how an upward trend is formed. So long as we have new highs forming in the market, that is how we call a structure, in the sense that an upward trend is forming. The same way when we come to the downward trend, okay, that's the market going in a downward direction. The same way when we come into the downward trend, you need to identify that a series of lows are being formed in the market, which validates our trend formation. Okay, so this is how the structure looks like. This is the structure of how the market works. So you need to understand that this is how the market works. Okay, you can see this in a 15 minutes time frame. You can still go into this and see this in the hourly time frame. You can still go into this and see this in the daily, the 4-hour. Market is so fractal to the extent that even if you go into the 1 minute time frame or even 1 second time frame, we will still be finding the market structure forming. That's how it works. Okay, so that being said, to clarify you on this, the same way we need to identify that our structure has been broken. Okay, a new low has been formed in the market. Okay, a new low has been formed in the market. That's what validates a lower trend or a downward trend. Okay, so here we can also name this break of what market structure, as you can see here. So we just need to identify that the market structure has been broken at a particular point in time to help us validate that the trend continuation is happening. Okay, so for instance, if we don't get a series of lows or a series of highs forming in the market, that doesn't validate our continuation of trend. That may be showing us that either prices are ranging at a point or prices is tending to reverse in a new direction. So let me give you a typical example of what I just explained. Let's take my path here. So for instance, we are in an upward trend and a series of what highs are forming to validate our upward trend for us. Now, instead of us to create a new high around this zone, we didn't create a new high. Now we got something like this, equal highs. Okay, equal highs, something like this. Before, probably prices came and broke our previous low in the market. Okay, creating a retest around that area, now validating our downward trend, because to validate our downward trend we need a series of low. Now this low has broke. Okay, so this is what we got. So for instance, let me explain this for you. For instance, we have an upward trend forming around here. Instead of us to break this, instead of this high, previous high to be broken to the upward side, okay, to the upward side, it didn't break. Okay, and now we have series of what highs and lows in the market, in the sense that we have equal highs and equal lows in the market. So I normally name this EQL or EQH. So here is an equal high and equal low. Here we can get something like, here sometimes market forms a double top or a double bottom depending on how the chart formation was, or depending on the trend where we are coming from. So here we had series of touches around our equal highs. Sometimes it can be two, sometimes it can be just one. Okay, just to validate what I'm trying to say. So that's when we can see that if we don't form a new high in the market, that's when we see that our upward trend is being depleting to becoming a downward trend. Okay, and this formed several times. So let's see, our previous low has been broken. After our previous low has been broken, okay, it has now come back to retest around this zone, and now we are creating a new downward trend. And what validates our downward trend? A series of new lows in the market. So now this is when we can identify that all the things that happen. Now that we understand the basics of market structure, we understand how market structure works. Now that we understand how market structure works, we can even go to the chart and see if we can get a more clearer understanding. Okay, so now let's hop into the EURUSD chart, and I'll give you a clearer view of what the market structure it's all about in the chart, how we can identify the way the market works. Okay, so for instance, if you take this particular chart here, let me clear everything so that, okay, right now we've already identified, we can identify that this is a downward trend. That's the first rule. We are in the 4 hours time frame, so you guys can really see it. So the first rule is that we've already identified that this is the trend. Okay, and now let's identify what qualifies our trend. Okay, so we take from the highs, see, then we take to this point. See, we've created a new low in a new high in the market. Okay, now a new high in the market. Let's create a new low to be able to validate our downward trend for us. Okay, now we've created this low. We come back. You see, this reality how it is. It's not like how I drew it, but then so long as we are not, let me take this. Let me take this. Okay, take this to the downward side, then this side. So we are still continuing our downward trend. Okay, so it's not like how I drew it, like all good, just so you just need to identify something. Like, no, sometimes it can be like this, but then the only thing you need to know is that this is validates when your previous high hasn't been broken in a downward trend, and we create a new low. Your previous high hasn't been broken. Okay, so we create a new low in the market. Okay, so as you can see, break of structure, because we've been able to break this our previous low in the market. Okay, another break of structure, we've been able to break our previous low in the market. So that's how it works. So for here, the reason why we want to understand this to help us in the market is because we want to know where our institutional traders are going to do what? Are going to take their next impulsive move. Okay, impulsive move as in this is an impulsive move, this is a correction, an impulsive move, correction, impulse, correction, impulse, correction, impulse, correction. So we want to identify where our traders, our institutional traders, are going to take their next impulsive move. Okay, so for instance, as we've highlighted, let's say for instance this is a move, this is an impulsive move and a correction, then we'll take our bar here to identify our previous low. So we would want prices to do what? Prices to come back and retest this zone. If prices retest this zone with the candlestick pattern we see around this zone, that's when we would. So for instance, I'm a trader. As I've seen this this pattern, this candlestick pattern. What is it? Is it pin bar or something? Yeah. You see, I think shooting star. So pin bar. So if you've seen this in the market, it will help you indicate that, okay, now I would like to enter short, because already we are in a downward trend and we don't do counter trend. Okay, we are trading with the trend. So all what you have to do is just to your risk to reward management 1:2. Then within just 4 hours, you've been able to accumulate this nice risk to reward in the market. You've been able to accumulate this nice risk to reward in the market, which really helps like you to make more profit in the market. The same way you'll be able to identify the zone if prices come around this zone again. As you can see, the same thing happened here. You see, the same thing happened here. Someone might choose to enter around this zone. Someone might choose to enter around here, put his stops here. Risk to reward ratio 1:2. 1:2. Okay, 1:2. Okay, so 1:2. The person has gotten his profits with just this one candle. Okay, the same way price came here again, refused to break. Okay, because still prices didn't do what? Didn't violate this previous high. Okay, so since prices didn't violate that previous high, we are still looking for what? A short term. So now, as we can see, this candlestick, this engulfing, bearish engulfing, will help us do what? Enter into this trade around this zone. Then we'll put our stops a little bit below market structure. Then we'll do risk to reward ratio 1:2. Okay, so we'll be expecting prices to continue to the downward side unless our previous high has been violated in the market. Okay, so as you can see, the structure is still continuing in the sense that our previous low has been violated. Same applies to an upward trend. So for instance, if we take this side, we have an upward trend forming. So as you can see, a higher high, a higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So as you can see, we didn't form a new high. We are saying that our market structure hasn't been Our market structure hasn't been broken to the upward side to continue or to validate upward trend. Okay, as you can see. So since we didn't form a new high, now we can see that our market structure hasn't been broken. You see, so for instance, let's take it like the same way how to place a trade, because we want to analyze where the institutional traders are going to take their next buys, okay, in this trade. So for instance, as we are highlighted here, simple and short, you just need to identify your support or something, then you just enter into this trade. Risk to reward ratio 1:2. So 1:2, risk to reward ratio 1:2. Okay, so 1:2, you take your profits, you are out of the trade. Okay, simple as that. Simple as that. You take your trade, you're out of the trade. The same way you take it here. You see, you just have to identify all these prices. So you take another trade here. It's just simple. This is how it works. But as time goes on, you'll be learning more complex stuff to get your precise sniper entry. Okay. So thank you for sticking with me, and I hope this little lecture was quite insightful. I hope by the time being, after watching this video, you'll be able to understand how to identify and spot a correct market structure to be able to enable you to enter into a trade, either long or short. Okay, and one thing you should also know is that you really have to consider your risk to reward ratio. Where in my next trade, I'll be treating on sniper entries. Sniper entries is that we are going to refine our entries into the lower time frames to be able to get a precise entry and lower our risk to reward ratio in the market. Please don't forget to like, subscribe, and comment below. Tell me the type of videos you want me to do, and I'll try my best to see if I can bring out the best content to be able to enable you to understand how the market really works. Thank you once again, and have a wonderful trading week.